Capital Record, where we defend free enterprise and capital markets because we believe in the dignity of the human person. Hello and welcome to David Bonson's Capital Record, brought to you by National Review. I am going to talk a little bit today about the One Big Beautiful Bill Act, but I'm not going to talk about the bill in all the ways everyone's already been talking about it, including myself. At my dividendcafe.com, you'll find a pretty extensive treatment I did on the bill just a few days ago, where I walk through all of what the bill does and doesn't do, means to markets. I try to bust a few myths about the bill and really call balls and strikes around what I like about it and don't like about it. And so, again, dividendcafe.com, which, by the way, not only is where this particular treatment of the bill is found, but for those that like Capital Record and are interested in what I have to say on these things, Dividend Cafe is where I'm doing all the time my various investment and market commentary work. Capital Record is very purposely meant to be a very ideological defense of free enterprise, but I'm not getting into commentary on the economy and markets. That's what I do at Dividend Cafe, and I'd certainly welcome you visiting both places. But when it comes to the One Big Beautiful Bill Act, there is something that does belong in the Capital Record conversation today. And it has to do with a few of the tax cuts that are in the bill. Many who are familiar with my philosophy of taxation, that essentially I'm a sort of Laffer's curve supply sider who believes we ought to be raising the revenue we need to fund the size government we want to have, which should be limited, and that we should be doing so with a tax code that produces as little impediment to productivity as possible. In other words, we want to have incentives to what we call the supply side of the economy, the incentivizing of production of goods and services that is responsible for economic growth and a higher standard of living. In other words, why I care about this at Capital Record is we're trying to drive optimal conditions of human flourishing. And I believe humans are capable of doing their best work when there are less impediments to such. And having a regulatory apparatus or a tax apparatus that gets in the way of that is suboptimal. So we favor, for example, a tax code that has more simplicity and a lower burden that then drives a higher incentive to go produce. The historical record of this is a little less philosophical and more of an economic and just simply empirical argument. And yes, it is to me absolutely indisputable in history that from the John Kennedy tax cuts in the 60s to the Ronald Reagan tax cuts in the 80s to Bill Clinton lowering tax rates on capital investment in the 90s to the Bush tax cuts on investment and income in the early 2000s to the Trump tax cuts on corporate income in 2018. Time and time and time again, we have seen greater productivity come out of lower tax rates and, in fact, higher revenues. So this is a basic, easy level defense of the supply side mantra. And I'm trying to attach it to why I think there's a philosophical apologetic here for this type of approach to tax policy. With the One Big Beautiful Bill Act, people could say, hey, they're cutting taxes. Why would you be upset about anything in it? And my point is, there are things in this bill that they're doing that I like a lot, even on the tax side. The business side of the tax treatment in this new bill, providing 100% business expensing deduction, making that permanent so companies can have reliability and stability about making capital allocation decisions, risk-taking endeavors, and know they're going to have a favorable tax treatment, a bonus depreciation to go start construction on factories, research and development expenditures they're going to be able to deduct right away and not have to amortize this deduction over a long period of time, basically from capital expensing to bonus depreciation to R&D expensing These are pro-growth supply side things that the new bill does that not only I am totally in favor of, but I think have been underrated parts of the bill. So, as critical as I am of what the bill doesn't do to address deficit spending, I am supportive of pro-growth supply side tax policy. But then some will say, okay, well, then you also must be happy about no tax on tips, the deduction for auto loan interest, no tax on overtime, no tax on Social Security. These were all campaign promises, particularly no tax on tips, overtime, Social Security. The auto loan interest thing kind of came a little later, but nevertheless, they're political tax cuts. Are these created equal with the other business tax cuts I granted were supply side pro growth friendly? I would suggest not only are they not created equal, they're actually outrageous for their stupidity and contradiction to the supply side mantra, which is to favor a broader tax base of lower rates applied to everybody. If the point is that we are trying to incentivize production, we are not incentivizing production by going to one particular job sector and saying we're going to give you a lower tax rate than other people that make the exact same amount of money as you do. And we're doing this for no other reason than to try to get your vote in the state of Nevada. Child care workers do not receive tips. Most chefs, cooks, back kitchen line workers do not receive tips. Housekeepers, maids, and those that work in housekeeping in hotels, work at the front desk at resorts, do not receive tips. Bartenders and waiters often do receive tips. There is a basic wage level to all the aforementioned jobs that is very comparable. But as a result of this, which is granting a $25,000 deduction, that's the way they're saying no tax on tips, is to allow you to deduct up to $25,000 of gratuity income from your gross taxable wages. Why? Why favor one sector over another? Is it incentivizing broad based work? It is adding compliance cost. It is not broadening the tax level. And if what you wanted to do, let's say the total cost of this selective, politically opportunistic tax cut was to cost to Treasury, the amount of revenue they're not going to receive from it was $10 billion. Then why not just cut the marginal rates by what the equivalent, whatever the percentage equivalent was of 10 billion for everybody? Or for everyone just in that particular sector of income, which is generally going to be people between $40,000 and $80,000, let's say. So you could apply the exact same tax cut to everyone and get a real incentive for additional wage earning, for additional work. But in this case, you take away the incentive, you don't broaden the tax base, you don't get more tax revenue or equal tax revenue from more people for lower rates. That's the whole mantra of supply side taxation. And in this case, you end up getting political favoritism that, as first of all, as a moral argument, is inequitable. Why should a truck driver who doesn't receive tips, a bus boy who doesn't receive tips, a front desk clerk who doesn't receive tips be taxed less than another one of these wage earners who has a gratuity income structure? It's irrational, unfair, but counterproductive economically to the objective we're after. The overtime wage issue. In this case, it's not a $25,000 deduction. It's up to a $12,500 deduction for overtime wages. But once again, why are we trying to incentivize one sort of wage earner when there is other structures that do the same thing? Now you say, well, people working overtime should get paid more. They are getting paid more. That's what the overtime is. So why should they have a lower rate on taxation and a lower effective tax rate? when somebody else who might be making the same income in a similar situation, but just has a different structure to how it's paid out. To the extent the wage earner is getting paid because they're working extra hours, that's embedded in the overtime pay. Why should they have then a favorable tax treatment versus others that are in a salary structure? Or worse, why should we incentivize companies to do workarounds, to game the system? This is everything us supply siders are supposed to be against. Then the Social Security issue. I hope I don't have to make an argument for why increasing a standard deduction to retirees over the age of 65, which what they're basically doing is giving a $5,000 bonus standard deduction, even for people who don't itemize, just for being over 65. It's a backdoor way of trying to just give some money back to seniors who are themselves collecting Social Security, which means what? If they're collecting Social Security at that age, it means they're not a wage earner. They're not working. So you tell me how that's driving productivity. Now you could say it's just a backdoor way to give wages back, give their own money back to them. That's fine, but we're not going to call it pro growth. You could say it's fair or not fair. You can say it's a good idea or bad idea. You could say it's going to cause them to go spend more money at the mall, but you can't say it is supply side driving productivity, driving production of goods and services. It's doing no such thing. It's basically giving a very small amount of money back to a bunch of senior citizens, which could be a good thing if you believe that they're overtaxed, but it is a politically opportunistic tax driver, not productivity. It is not driving the supply side of the economy. And then it gets me to this fourth part of the individual tax code, which is the deductibility of auto loan interest. And this is not only a nothing burger of a revenue generator to Treasury, but it is maybe one of the most offensive taxes in the new bill philosophically. It is absolutely outrageous that the tax code would discriminate against people who choose to save up and buy a car with cash. And you would give a tax break to people that are borrowing money. Now, I'm not saying there's anything wrong with borrowing money to finance a car, and other people may use borrowed money to lease a car. People are going to have all sorts of pros and cons in their decision making process. But if they choose to capitalize the car, why would we want to use the tax code to reduce their total tax burden relative to someone else who didn't? So, two people who earn the same amount of wages, both have an automobile. One of them borrowed money to get a car, one didn't. And we're giving a tax break to one versus the other. It's obviously not supply side producing incentives to produce goods and services, but I would argue it's counterproductive. It's incentivizing the household leveraging. And why should someone who has to borrow, you say, well, maybe they're hard up. We're giving a little break to somebody. What about people that are paying bills on a credit card every month? They must be very hard up. That's even more expensive borrowing, more irresponsible, more reckless, and I assume more desperate. So I'm not trying to produce a moral judgment here on people doing it, but do we want to incentivize that in the tax code? Now, at the end of the day, my main objective here is to make very clear that these things are just simply not pro growth. If people like them for other reasons, then that's different. I don't like them, but we at least are trying to start with the conclusion that these are not pro growth tax cuts. But I'm also further arguing that they are counterproductive to what we believe is an optimal tax policy, because as a supply sider, we believe in broadening the tax base and avoiding the negative results that come when there are winners and losers picked in the tax code. A lower marginal base of taxes for a broader amount of people is the simplest and most economically productive formula. There are different ways to get there, different knobs to be turned, but interventions like no tax on tips and special deductions for overtime and the standard deduction for seniors and the auto loan interest nonsense. This is, in my opinion, intervention that creates a distortion. It will create cheating and it will create gamesmanship and ultimately is a wasted effort relative to what could easily be done in a much more productive way which is take the total amount of money you're trying to give back to taxpayers, and instead of giving it back to just some, give it back to all with broader, lower marginal rates. This is pretty easy. And it's also what Reaganites have long believed. So if we're saying, hey, now there was a political promise made here, we got to keep it, that's fine. But let's just call it what it is. This is trying to buy votes. And that is not the same as a supply side tax agenda. Thank you for listening to David Bonson's Capital Record. Very much looking forward to being with you again here this week, where I will be providing some commentary in a couple days in defense of Bill Ackman, a billionaire hedge funder, and why my comments are not really about Bill Ackman at all. Stay tuned for Capital Record in a couple days. Check out dividendcafe.com for more commentary on the tax bill. And thank you, as always, for listening to David Bonson's Capital Record, brought to you by National Review.